Hello and welcome to the 49th edition, would you believe, of MHQ Foundation 101 webcast, where today, in the theme of the month, which is really to touch about foundation and real estate, we are going abroad, where the Olympics will be held, no less, La France. And for that, I have my two buddies, Benoît Philippard and Nicolas Sis, to help me to understand how UAE Foundation can be compatible with real estate and other France C2 assets. So guys, thanks a lot for taking the time. Before we jump into the asset class itself and the compatibility with France, etc., give us a little bit of background about yourself and your firm.
Thank you, Jan. Thank you very much for this introduction. So my partner, Nicolas Sis, and I, Benoît Philippard, are French attorney at law and the founders of Latour International, a French tax law firm based in Paris and in Switzerland. Basically, we provide international tax assistance to entrepreneurs and private clients, and most of our diligence relates to trusts and foundations. So we are very pleased to be with you today, Jan.
And it's not our first rodeo, so very happy to discuss actual life cases with you. So if I'm looking at the big picture level, at the international level, our clients are always wondering whether foundation and French law are compatible. So what is the big picture answer to that?
Yeah, hello, Jan. Many thanks for your invitation. So actually, this is a very, very good question. A French tax resident will rarely set up a trust or a foundation because this may entail significant French tax implications. Usually, a French citizen sets up a foundation when he is no longer a French tax resident, example given, when he has moved to the UAE on a permanent basis. This being said, trusts and foundation are fully recognized under French tax laws. Residency status at inception matters. In this regard, a law was enacted in 2011 to specify the French tax treatment applicable to these entities, to trusts and foundations. Of course, it is clear, at least to all people following this webcast, that a foundation is not a trust, but for the purposes of French tax, a foundation is to be regarded as and must be treated as a trust.
So a good start there. So the foundation is understood, recognized, known by the French authorities, and provided I am in a reasonably fiscally neutral country like the UAE, let's see if that can actually be beneficial to hold something in France. So let's go into that, into the French tax law. And how does it treat the concepts that we know in a foundation of a founder and to a lesser extent the beneficiary? How does that work?
In France, we have the same concept because the founder is the individual who basically set up the foundation. And if the foundation was set up by an individual acting in a professional capacity or by a legal entity, then the founder is the individual who places the assets and rights in the foundations. And when the founders die, the beneficiary of the foundation is deemed to be founder of the foundation with respect to assets, rights, and the capitalized income in the foundation.
So what I want to jump in, very useful, what I want to jump into are the sort of key features to really consider when setting up a foundation for France C2's asset, and something to understand that is a little bit more complex than what we have in the UAE. So I want to talk about personal income tax, real estate wealth tax, and gift and inheritance taxes, and how these would apply. So these are the main French tax consideration that I need to be aware of, right?
Yes, exactly. It is the main three taxes that we recognize in France, and especially with respect to personal income tax. If you want, we can investigate further.
Yeah, let's do that, because that is a concept that is a little bit alien for us lot, whether UAE national and based or the people that actually move to the UAE. No personal income tax here, God bless. So please walk us through the potential impact of personal income tax for someone that would have a foundation with a French C2 asset.
It was a great pleasure, Jan. And to assess, the liability of a person to French personal income tax, the first question we have to answer is whether the beneficiary, with often the funder or maybe the beneficiary deemed to be funder, may be considered as a French tax resident with respect to French tax law, but also to international tax treaty. And also whether the beneficiary receive French source income. And the tax residency question may be very complex in the French UAE context, because, as you know, it is appreciated based on the French domestic tax, as it is mentioned in the treaty at section 19, paragraph 2 of the tax treaty. And even, you know, if there is no distribution, there might be some French personal income tax due. So in practice, we often meet three situations.
Okay.
First situation, when the beneficiary is a French tax resident, and when he receives distributions, the foundation, the beneficiary may be liable to French personal income tax at the rate of 30% or 34%, as it is mentioned on the slide that we can see.
Yeah.
But you know, even if the in the situation where the beneficiary can demonstrate that he has not received a distribution and that it is a reimbursement of the foundation contribution, then in this case there is no tax due. And this really implies, when you have a foundation, to have a proper accounting of the foundations. This is the first situation. The second situation is where you have a beneficiary with a French tax residence, and when, you know, the assets of the foundations mainly consist in financial investment. And by mainly consist in financial investment, we understand, you have to understand, more than 50%.
Okay.
In this situation, when the French tax residence, even if it does not receive any distribution, the French tax residence may be considered as liable to personal income tax if, you know, the foundations is located in a country where it has a preferential tax regime, which is the case, as you know, in Dubai.
Correct.
First situations is where none of the parties are French tax residents, which means the founder is not a French tax resident, the considered is not French tax, there is no member considered French tax residents, and, you know, the beneficiary is not French tax residents. When none of the parties are French tax residents, if, you know, the foundations hold real estate in France, for instance, in some situation, we can have personal income tax due in France or corporate income tax due in France.
So clearly a pivot towards, if I'm abroad, if I use a structure abroad, and if I'm non-tax abroad and control abroad, it's relatively lenient, yet you still need to analyze the situation correctly, not to misstep, and we're going to see the compliance obligation in a minute.
Exactly.
We talked earlier about the real estate wealth tax, the so-called IFI. Can you walk us through this? Because that is a situs asset real estate in France, and that is taxed at that level. So how does it work when the assets is in a foundation?
Yeah, with pleasure, Yann. The so-called IFI or IFI in French. Originally, maybe it's interesting to say that there was a so-called ISF, Impôt de Solidarité sur la Fortune, and this wealth tax, ISF, encompassed not only real estate assets held directly and indirectly, but also movable assets and financial assets. And this ISF has been replaced in 2011 by the so-called IFI, as you said, by President Emmanuel Macron. So maybe a few words on the French domestic tax rules about IFI. Real estate wealth tax, so-called IFI, is due whenever a taxpayer holds real estate assets in France, either directly or indirectly through a corporation, through a trust, or a foundation, or a partnership, and when the net fair market value of these real estate properties exceeds a threshold, which is 1.3 million euro as of January 1st of the year. IFI rate ranges between 0.5% and 1.5% of the net value of the real estate properties. When an IFI is due in France, you have to file, the taxpayer has to file a tax return in France in May every year. Also, maybe to know is that a sui generis levy, 1.5% of the fair market value of the property, is due if the taxpayer has not filed an IFI tax return and if the members of the council or foundation have not fulfilled their reporting obligations. Now, maybe a few words about the French UAE context, because there are obviously good news in this respect. There is a tax treaty, as you know, between France and the UAE, and there is a provision, which is Article 16A of the tax treaty. And accordingly, if he is not due, if the taxpayer, who is a tax resident of the UAE, holds French shares listed on the French stock exchange market for an amount which is higher than the value of the French real estate assets. So obviously, good news for UAE tax residents.
So super good news, and also good news probably for a French private bank that want to custodize these portfolios. So what about you illustrate me this with a live case, because I've seen the importance of compliance and this balance of value. So if you can walk us through that.
Yeah, with pleasure. Yeah, indeed, you are right. So let's take this example. Let's consider the following facts. We have a UAE tax resident, foundation in Dubai, and the assets held by the foundation are twofold. First, a real estate property in France, a nice villa in the south of France, let's say, for a value of 10 million euros. But I think you are right to say that it is key to have a proper valuation of the real estate property. And then this foundation also holds bank account and shares like Total, Air Liquide, an example given LVMH for 12 million euros. So first question is, if he due in this situation? The good news is that as long as we can show that the taxpayer is a UAE tax resident, and as long as we can demonstrate that the fair market value of the property is less than the value of the French shares and the European Union shares, then it would be rather good news for this taxpayer, because thanks to the tax treaty concluded between France and Dubai, he could enjoy an IFI tax exemption.
Pretty interesting this. So a little bit of planning to optimize that, but clearly avenues to optimize, which is good because you're not penalized just because you want to use your UAE foundation for French real estate. Super. The last bit that I want to talk about, because that's something that we do not have in the UAE, which is gift tax, inheritance tax. So let's assume in your life case here that the patriarch passes, that the founder passes. What would be the treatment at the French level for this real estate asset held directly by the foundation or through an underlying company? How would that work?
First things to note is it is important is that, you know, the French UAE tax treaty only covers inheritance tax, which means that gift tax is not covered by the French UAE tax treaty. And therefore, you know, only in the case where the decease of the founder can be appreciated based on the French UAE tax treaty. The case of the settlement of the foundation with a founder or beneficiary tax residents in France has to be appreciated based on French tax rules only. So this being said, if we come back to the examples that we just saw with Nicolas on the real estate wealth tax, and if we try to consider this example based on inheritance tax, then it is important to note that we have, you know, this Article 17 of the French UAE tax treaty, which covers some situations where the foundation is holding, you know, real estate properties or tangible and intangible, you know, movable assets. When, you know, we have real estate properties, the tax treaty basically says that the real estate property is taxed where it is located. So, example given, if, you know, the foundation is holding directly or indirectly through a foundation's a real estate property in France, then inheritance tax should be due in France. And
Yeah, keep on.
You
What
know,
about if the
one of
founder is a resident of a third party, then, of a third country, then?
Yes, it is very important what you say, because we are appreciating the situations where the deceased is UAE tax residence. So unfortunately, if there is no UAE tax residence, of course, the situation will have to be appreciated depending on the tax residency of this person. So basically, we have to look at the treaty, if there is any treaty between France and this tax residency of the deceased. Yeah.
Thank you. Very clear. We mentioned earlier, and I'm coming back to the wealth tax in particular, that there is a sui generis taxation if someone forgets to report. So let's talk about these reporting obligation, because in the UAE we have ESR, UBOR, a few reporting obligations to the states for any permanent establishment, including foundation. My question to you is, if I have a foundation holding, say, French real estate, what are my ongoing reporting obligations, and what if I do not comply?
Yeah, very good question, Jan. Many thanks. Actually, a foundation, whenever a foundation has a connection to France, then there are two types of reporting obligations that must be fulfilled by the members of the council of the foundation. So basically, if the funder, or if one of the beneficiaries, or if there is one single asset, French share, or real estate property, which is held by the foundation, then the council of foundation must comply with a series of reporting obligations vis-à-vis the French tax authorities. And it is really key to comply with these reporting obligations, because otherwise there is a fine, which is 20,000 euro. And so compliance is really key. The founder and or the beneficiaries deemed founders are jointly and severally liable with the foundation for the payment of the fine. This is why we have a dedicated team at Latour International to assist our clients and trustees and council of foundations to prepare and file these trust forms, these event declarations and annual declarations, but also, of course, the income tax returns and the IFI tax return. Maybe one last comment is that if the foundation for any reason must regularize its tax situation, we strongly recommend that this foundation should regularize this tax situation vis-à-vis the French tax authorities. Statute of limitations is 5 years.
Okay, so look, this is fantastic, because when we first started to look into this topic at the firm level, we were always a bit scared about French asset. It must be complicated. It's a high tax country, etc. And then we discovered you guys, because I think the ability to advise is one thing. The ability to ensure that you can file compliantly for whenever you have a cross-border structure is paramount. So there you go. And this is based on live case and previous experience with the Latour team. So thank you very much, Benoit and Nicolas. This is eye-opening. I'm sure that you are going to have a lot of requests from people that actually have foundation here in the UAE. We expect roughly 500 to be registered this year. And a good bunch of these, of course, have real estate and some French real estate. So there you have it. This is it for us. Thank you very much, gentlemen, for joining me on this little webcast. And next week, your usual host, Kat Zagati, will be joining me to continue our real estate tour of other jurisdictions. Thank you very much. Good afternoon. Bye-bye.
Bye.